The repercussions of COVID-19 have continued to dominate markets throughout this reporting period. Equity markets rebounded strongly since the previous quarter, despite rapidly worsening economic data, as official figures reflected the impact of lockdowns across the world. Just as equity markets fell in anticipation of the economic impact from COVID-19, investors now appear to be pricing in a rapid V-shaped recovery later this year and into 2021. The notable performances came from global emerging markets, Europe, Asia Pacific and North America. UK gilts remained almost flat, whilst UK all companies rose 1.17% in value. The widespread economic lockdowns applied to control the spread of COVID-19 have been remarkable. Under normal circumstances, this action would have triggered a collapse in economic output and global stock markets. However, the potential temporary nature of the lockdown, coupled with an extraordinary level of stimulus, has created the metaphorical equivalent of putting your head in the freezer and your feet in the oven, thereby being the right temperature on average, but very uncomfortable. Some markets, like the UK, remain well below previous highs, whereas others, like the tech-orientated Nasdaq, have reached new highs. It feels as though the global economy has become a COVID casino, due to the current high level of uncertainty, especially in the short term. Although challenging, we believe we have been able to develop a cohesive investment strategy based on detailed observations and carefully considered expectations. COVID-19 infections have been controlled in many economies, including China, South Korea, Italy, Portugal, UK, Sweden, and many more. A further increase in infections has been recorded in the US and Spain, with new outbreaks in India and South America. Although detected infections have risen significantly above the initial peak in March, deaths have remained below peak levels, indicating that the initial global wave of infections is continuing to mature. The learning curve in response to COVID-19 is steep, with economies ramping up social distancing measures, testing and treatments, to the point where economies can reach around 90% output while managing the risk. The prospect of a successful vaccine is likely, although not certain, with several potential drugs in final trials having reported encouraging earlier results. A successful vaccine would boost equity markets whilst downside risks appear to be subsiding as conventional management strategies evolve, limiting further economic pain. Russia recently announced they would be beginning their vaccine program in October, with the UK leading the Western world response, looking to deploy a vaccine before the end of the year. We are holding an overweight allocation to equities as we believe downside risks are lower and falling, while upside prospects are attractive and supported by ongoing stimulus. Inflation is a significant factor, which markets could be underpricing. We have discussed that the surging gold price is signalling higher future inflation, and there is evidence to support this. The inflationary effects of post-credit crisis measures were surprisingly limited, given the level of money created by central banks. At the time, central banks were careful to move money in global bond markets to avoid direct spending, to reduce the risk of inflation. This time, the approach appears more complacent, with cash injected more quickly directly to people and businesses, creating a hard transmission route into the economy and increasing inflation risk. We feel the risk within debt markets has transferred from the borrower to the lender, due to the sub-inflation yield, and so we are holding reduced exposure to this asset class and focusing on short-term, high-quality debt providing returns ahead of inflation. As we move through August, the Brexit deadline of December 31st is approaching, and we expect Boris Johnson to honour his promise that the deadline will not be extended. After 4 years of uncertainty, the question of our future relationship will finally be answered. Surprisingly, news flow has been light, in contrast to the regular hostile press leaks from both sides during the withdrawal agreement negotiation. We suspect that no news could be good news and remain optimistic that a deal will be reached. This is in the interest of both parties, especially given the additional risks to trade presented by COVID-19. If a no-deal outcome emerges, the downside risks have reduced, as COVID-19 and its global economic response have trumped the relative pain to the UK economy. The encouraging outlook for the UK is also matched with an improving position for European markets. The EU reached a historic agreement in recent weeks to provide a €750 billion bailout fund. The EU failed to act swiftly following the credit crisis in 2008-2009 and became dogged with wealthier members refusing to bail out countries such as Greece and Portugal. When the agreement came, it was too little too late, leading to a slower than optimal recovery in the European economy. Although tense, the negotiation and response to COVID-19 has been far quicker and led to a boost in confidence for equities and the EU. The EU may be keen to maintain this momentum by reaching a trade deal with the UK, as the alternative is damaging for both sides. A full PDF commentary of this quarter is available on the Margetts website. Margetts Fund Management, specialising in managing risk-rated multi-manager funds.